The end game is coming. For over 18 months, we've seen tremendous growth in the stock market. There has been overall euphoria and a general sense that the stock market could only go up. Of course, this was due in large part to the Federal Reserve's aggressive bond purchase initiative that essentially served as a money printer. But the end game is coming. Like Thanos and the Avengers wielding the Infinity Stones to wipe out half of all existence, Jerome Powell has essentially picked up the proverbial Infinity Gauntlet on the stock market, and one announcement could send high-flying growth stocks into a free fall, wiping out any previous gains in record time. This is Mark Talks Finance, and today we'll be talking about the end game to the stock market as we know it today, and specifically what to do in an era of volatility. So if this sounds like something you'll be interested in, drop a like down below as it helps out the channel and lets me know what sort of videos you like so I can keep giving you more of that. Now with that said, let's get into the video and talk about the announcement that Jerome Powell yields that could potentially wipe out any gains just like Thanos. And that announcement will be the raising of interest rates. Now there is a general certainty that this announcement will occur most likely in March, with several interest rate hikes anticipated from that point onwards. And check this out, the very thought that this is coming, all right, the thought of interest rates increase happening has already sent shockwaves in the market ever since the minutes of the last Fed meeting were published. At the end of January, the Dow Jones dropped as much as 3% before finishing the day barely in the green. The S&P 500 has been down more than 9%, and the Nasdaq 100 is down just over 8%. Of course, these numbers change from day to day, so at the time you're watching this video, it might be different. But anyway, you're probably wondering what comes next, but that isn't the right question to be asking right now. First reason being, no one has a crystal ball. All right. Now, investing is more about preparation and opportunity based on projected market conditions. And what is projected right now, at least in the near term, is most likely a lot of volatility as a result of uncertainty. The important thing, though, is to maintain a long-term perspective, even in the face of market uncertainty. This is a key period for you to determine exactly what type of investor you are. Now, those who just started investing within the last 2 years probably imagine that the growth that we're seeing right now is normal. After all, stocks only go up, right? Well, the sort of growth that we've been seeing this past year, which is the 20 plus increase, 20 plus gains, the hyper gain, as well as the fluctuations within that period, all that is definitely not normal and it's an aberration. Now, the two driving factors behind the latest behavior in the stock market are definitely the government policy, and the other, which is not talked about enough, is market conditioning through automated investments. Okay, let me explain. The first one is fairly straightforward and you've probably heard it a million times, but I'll run through it real quick. Okay, now the Fed Reserve intentionally took actions that resulted in low interest rates environments in order to infuse the market with trillions of dollars to spend after the COVID pandemic. And it worked. More spending resulted in more money in the market, which drove stocks up and kept the market afloat. Now, on the flip side, however, whenever stocks attempted to correct themselves like they should do, institutional investors and hedge funds had buy orders that were triggered to purchase stocks whenever they fell below a target threshold, which kept stocks from falling too far and also prevented a correction that would have kept the market valuations closer to their true value. So imagine this, a stock is going like this, it starts to correct, it gets past a certain threshold, the buy order gets triggered, multiple buy orders sends the stock back up above its intended destination, keeping everything afloat and thus giving the illusion that the market is bouncing back. Now, all this led to a false sense of security and essentially conditioned the average investor to be more comfortable taking risks that otherwise would not even be given a second thought. Again, stocks only go up mentality. Now, this is a reason why we saw a surge in EV, green energy, and biotech stock. Remember the number of SPACs that launched in 2020? It was definitely a wild time back then. Now that the bell is being rung to signal the end of the Fed propping up the market, it is even more important to remember to think long term. Now is the time, in the midst of all the uncertainty, to really understand who you are as an investor. As an investor, you need to have a long-term outlook. It's not about how much you've gained or lost today or tomorrow, but how much of your investment you are able to get a return over the long term. Warren Buffett's 2 rules on investing are this. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Now, it's important to remember that your losses will offset any gains you make. There's no point in chasing a 70% return, as there's a greater chance that you will lose that investment. However, it's prudent to make sound, calculated moves especially in a turbulent market. Now, this would be a time of fear, but the moves that you make now could have a lasting impact for decades, especially when you look back 5, 10, or even 20 years from now. When you look back, you're not going to think about uncertainty. You're going to think about what could have or should have been. If you're a young investor, you could probably think, oh my goodness, I should have spent more, or you might even be upset about certain investments. Now, if you're older or if you're at retirement age, you might be happy that you scale back on certain investments. At the end of the day though, remember to think of investments as transferring money from your present self to your future self. And your earning power as you get older first goes up, but eventually it will come down. So use this time to make smart decisions and have a plan in place, because the market over the long term will have periods of uncertainty, but part of being a long-term investor is knowing whether you can handle it. And if you're unsure of what to invest in, a broad market ETF that tracks the S&P 500 has been proven to beat over 95% of hedge funds. So that's a good foundation to any portfolio, in my opinion. With that said, I'll wrap it up here. What do you think of the market right now? Has this given you thought to reevaluate your portfolio? Are you looking to make any adjustments or add to any existing positions? Leave a like down below if you found this video helpful. If you have any tips to share or just want to say hello, leave a comment down below as well, and I'll respond there. Once again, thanks for watching, and I'll catch you in the next video. Peace.